You guys know that I watch a lot of interviews, I read a lot of articles, see a lot of videos, and I'm pulling out a few of my favorite things I've seen over the last few days, and they're all telling one single story. They're all talking about this bizarrely overvalued stock market. Speaking of this bizarrely overvalued stock market, the first article I want to mention is from Yahoo Finance. The bizarrely overvalued stock market is poised for a big correction, and the smart money is moving into cash. Indicators are pointing to a major correction coming for stocks, market strategist Paul Dietrich says. Says the market is bizarrely overvalued and the smart money is moving into cash. When he's talking about smart money, he's talking about Elon Musk, Warren Buffett. So the big investors who are considered smart money, maybe because they have the most of it. But there's plenty of red flags that he gets to in this article I want to bring up. Red flags are rising in the price to earnings ratio for the S&P 500. And multiples mirror levels that were seen prior to the dot-com bubble crash. And we'll get into the dot-com crash a bit later in this video because we're talking about the Q ratio and how the market came down so quickly from that overvalued position. But let's get back into this bizarrely overvalued stock market article. Every single indicator seems to tell us that we're in a historic bubble, Dietrich said. It's hard to look at that and then see that we're not going to see a major correction coming. Now is not the time to be putting new money in the market. The biggest indicator of a coming correction is smart money investors who are moving out of the stock market and into safer cash investments. And besides the ones I mentioned earlier, he also mentions here the Walton family. They're the ones who are the heirs to the Walmart fortune empire. And speaking of Warren Buffett, that leads us right into the next article I want to bring to your attention. This is from CNN before the bell. Warren Buffett's favorite market indicator is flashing red. Widely known as the Buffett indicator, it measures the size of the U.S. stock market against the size of the economy by taking the total value of all publicly traded companies and dividing that by the quarterly estimate for gross domestic product. I can tell you that this is a very effective indicator for anticipating stock market bubbles that are about to pop. Buffett's Berkshire Hathaway says that a reading of 100% is fair. If it's closer to 70%, stocks are at bargain prices. And if it's anywhere near the 200% mark, investors are playing with fire. The indicator is currently sitting near a 2-year high at nearly 190%. The last time the indicator was this high was in 2022, where it hit 211%, and the S&P 500 dropped by 19% over the year. And this next one comes from Barron's, which holds a place in my heart because my very first interview ever was with Barron's. I went to the bookstore and went and bought a copy of the Barron's newspaper. And then by quoting it, I thought I had made it. So this is from Barron's. 3 signs a bull market is about to tumble. Number 1, overvaluation, such as price earnings, price to sales, price to dividends ratios. But they go on to say that those are notoriously poor for actually spotting the market breakdowns. They go on to say wide divergences are another sign. Think of the Magnificent Seven, how they've made an outproportionate size of gains in their stock price compared to what most stocks are doing. The markets seem to be going up. Those 7 stocks are doing fine, but there's underneath the surface a lot of stocks are not performing as well as you would think that all stocks are actually performing. But most importantly, the third thing they go on to talk about, a sign of a coming financial tumble, is a struggling financial sector. There's been problems in the banking sector. You can learn more about it. I put even in some of the YouTube short videos. I made a new playlist of economic brilliance, and I just put certain sections from things that Nomi Prince said, Frank Justra, added one from Gareth Soloway today. These are just brilliant things, and one of the things that Nomi Prince talks about is the banking problems that we've been seeing last year in Europe, this year so far, and the banking crisis that is to come. So that is the third sign of a potentially tumbling stock market from this Barron's article. This is the Shiller-Cape ratio, which usually explains or points out overvaluation. There's been a change of 2.25% from last month, and it's up 21.54% from 1 year ago. Here, if you look at the all-time chart, you can see here it's 1929. People are talking about permanent prosperity. Anybody who thought the market was going to go down would be pillarized. Everybody would fight against that person or try and tell them why they're incorrect and why the market can't keep on going. Sort of like now. Permanent prosperity, right now we're talking about, well, we've got all this AI. It's different this time because of AI. But here's the big one, the granddaddy, the dot-com bubble. The Cape ratio got to an all-time high at that point. Got to an all-time high of 44.19. With the exception of the dot-com bubble and the stimulative spending in this period of time, with the exception of those two, this Cape ratio has never been higher. The higher it goes, the more likely we are to experience a stock market recalibration in the coming weeks, months, quarters. Now we get into one of my favorites, and you guys might have heard me talking about this exact same thing 10 years ago. This is the Q ratio. I'm going to tell you simply, super simply, they basically take the value of all the stocks and divide it by the cost to replace all of the assets of those stocks. This one is from Advisor Perspectives. The Q ratio, you can see the chart here. There it was in 1929. It hit 1.06. Hit at 1.08 right before the beginning of World War II. And then you can see it dropped a lot. You can assume from that the stocks at that time declined, of course. But let's skip way ahead here. Dot-com bubble, recent highs, stimulus spending, and now we're approaching those levels again. Every time the Q ratio in history gets above 1.0, it always overcorrects, and sometimes that overcorrection can be quite extreme. When you're hearing things like most stocks going down 85%, and I'm not saying that's going to happen. I'm just telling you, I'm showing you some things I saw that I agree with, that you can decide for yourself if you agree with them. The Q ratio right now is at 1.59. That is a massive warning sign if people tend to take the warning. Now for this one I had to go pretty deep. This is from the Financial Accounts of the United States from the Federal Reserve. This particular table I'm showing you is the household net worth and growth of domestic non-financial debt. So said another way, you can look here and see what the household's net worth is on average on certain years. But when I was looking at this information the other night, I saw something very interesting. House prices. You follow them here along with me. They increased a little bit, measurable, maintainable, not too much at once. But it was right here that all of a sudden house prices jumped up on a percentage basis more quickly, up to $150,000. And I said, what happened there? And then you look back and go, well, I don't know what happened around that time. Oh yeah, there's all the stimulus measures. And all of a sudden your house price is a lot higher. All prices are a lot higher. Your groceries, precious metals, diamonds. And these numbers here are all about how much the debts have grown. Federal government debt grew by 5.4% in 2014. But in 2020, federal debt grew by 24.1%. That is a problem. But swing down here to last year, quarter 2, 3, and 4, federal debt grew 12.7%, 10.6%, 10%. That is absolutely wholly unsustainable in any possible way. The debt bomb is going to hit us in the face. No one has made any solutions how to get out of this. And when the unemployment rate declines or the GDP rises, a lot of times that's because the federal government created a bunch of new jobs. But let me ask you, after seeing all this, and I don't have a horse in this race, I'm just trying to find out what's going to happen ahead of time so I can benefit from it, or help you benefit from it. What do you think about this bizarrely overvalued stock market? Just think about some of the things we talked about in this video. The Cape ratio, signs that the stock market is about to tumble, Buffett's indicator flashing a red warning signal. How are you going to act? How are you taking this information and are you agreeing with it? What are you going to do? How are you going to better your position, help the people you care about, and be in a better place a couple years from now than you are right now? Seriously, there's a value in knowing what's going to happen ahead of time because there's different options you can take to enrich yourself, build your wealth when that happens. If everything we're talking about here plays out, is there any way that you could imagine that you could have landed on a good place or made a few dollars here or there? But just remember that there's never a certainty. All we're talking about here, or all we're talking about ever, is just based on probabilities. What is most likely to happen, not what is going to happen. I've never told anyone what is going to happen. You're going to want to keep an eye on all of these things we talked about today, other things like this as well. You want to keep an eye on what's going on in the macroeconomic environment, in the focused stock market environment here at home. You want to keep an eye on the right headlines and understand what they mean. The good news is that you can make all of that happen right now. Stay connected with us by subscribing to the channel. Thank you so much. If you want some of our free learning tools, or you want to see why the Peter Leeds newsletter is one of the most popular financial newsletters of all time, swing over to peterleeds.com and you can learn all about it.